Welcome to this explainer. Today, we're breaking down a massive shift happening right now in energy project finance. We're going to look really closely at why the traditional financial models for utility-scale battery storage, the exact models the industry has banked on for years, are completely breaking down. It's wild. If you're tracking the energy transition at all, understanding how asset owners are navigating this extreme market saturation is absolutely essential. So let's map out exactly how they're doing it.
Okay, let's dive into this. Pure merchant risk is proving to be a dangerous gamble. Man, doesn't that sum it up perfectly? For a long time, operating in the short-term wholesale energy market was super straightforward. You built a huge battery, played the market, and boom, you made your money. But as these energy markets mature, the era of simple merchant optimization is officially over. Relying purely on short-term wholesale market exposure has literally transformed from a rock-solid business plan into a highly dangerous gamble.
Section 1. Traditional Merchant Revenue Models.
To truly understand why things are falling apart today, we've got to look back at the baseline, the classic merchant model. And this brilliantly illustrates that simple three-step arbitrage playbook. Step 1. You charge your massive utility-scale batteries when grid demand is rock bottom and power is dirt cheap. Step 2, you hold on to that power until grid demand spikes, like early evening when everyone gets home, and you discharge it right back into the grid. And Step 3, you profit off that expected arbitrage spread. It's your classic buy low, sell high strategy. It was clean, it was predictable, and for a good while, it easily covered the heavy capital costs of building these massive storage facilities. Section 2. Extreme market saturation.
But here's where we hit a wall. The uncomfortable reality is that this traditional model is colliding head-on with extreme market saturation. The immense success of renewable energy is fundamentally rewiring the physics and the economics of the grid. Think of it like rush hour traffic. We are now seeing midday solar surges aligning simultaneously across massive regional hubs. Because all of this solar generation hits the grid at the exact same time, we're triggering widespread negative pricing windows. That means generators are literally paying to offload power. Just to put that into perspective, in major markets like California's CAISO or Texas's ERCOT, we aren't just seeing occasional dips anymore. No, we're seeing hundreds of hours of negative pricing every single year. The entire market is trying to charge at the exact same hour and later discharging into a grid that is already totally oversaturated. It's a massive grid-wide traffic jam of electricity.
Now, what's really interesting about this slide is how you can clearly see this traffic jam destroying the financial model. That first bar? That's the healthy, expected arbitrage spread operators used to comfortably bank on. It's what the original financial models were built around. But then, look at the staggering drop-off in the actual spread. Because of extreme market saturation, when everyone discharges into an oversupplied grid all at once, that expected spread is totally wiped out. The value drops through the floor, straight into a negative pricing window. So that margin you were counting on to pay off a multi-million-dollar battery asset, it didn't just shrink, it vanished into thin air.
Section 3, the return on capital paradox. And this brings us to a really fascinating, albeit super painful, structural issue in energy finance. You see the deep irony here, right? Utility-scale storage systems are built specifically to support the massive influx of renewables. But financially, they're being completely undermined by the very peak renewable hours they are meant to balance. In the old reality, simple merchant optimization easily covered your capital costs. But in our new reality, collapsing arbitrage spreads mean that trying to recover your upfront capital through pure merchant risk is basically a dangerous gamble. The baseline assumptions of your financial model are just structurally broken. And honestly, that is an absolute nightmare for balance sheets.
So put yourself in their shoes for a second. If you're holding these assets on your balance sheet, the immediate, urgent question is, how on earth do we survive this return on capital paradox? If the wholesale market is this saturated, how do you actually secure a bankable cash flow?
Section 4. 3 risk hedging strategies.
So the crucial point is, surviving this paradox requires a massive structural pivot. Asset managers and financial investors are basically being forced to scramble away from merchant risk and move toward heavily hedged financial structures. You just can't cross your fingers and rely on the open market anymore. To lock down bankable cash flows, asset owners are shifting to 3 complex but absolutely essential strategies: long-term tolling agreements, capacity mechanisms, and co-located hybrid structures. Each one of these serves to surgically remove pure merchant risk from your balance sheet.
Okay, let's break these down. The first major pivot is the long-term tolling agreement. This is a really complex, multi-year contract where, as an asset owner, you agree to hand over the dispatch control of your battery to a third party.
Usually, this is a large utility or an established energy trader. Now, why would they want this? Well, the utility gets to use your battery to balance their specific, massive generation portfolio. They get the precise physical control they need to manage grid stability. And in exchange for giving up the right to play the market yourself, you get a guaranteed fixed revenue stream. You're basically trading the theoretical upside of potential high arbitrage spreads for the ultimate downside protection. Guaranteed capital recovery that is completely shielded from market saturation.
Let's move to the second strategy and see how this builds on the idea of secured income. This one relies on capacity remuneration mechanisms, which most people in the industry just call capacity markets. Instead of getting paid only for the actual electrons you buy and sell in real time, this mechanism structurally guarantees income based purely on your availability. The grid operator pays you a fixed fee simply for existing and being ready to supply electricity during critical peak demand events. Think about an extreme winter freeze, or maybe a blistering summer heat wave when the grid is pushed to the absolute brink. They need an ironclad guarantee that power will be there when they call for it. So this creates a foundational, highly predictable layer of revenue. It acts as a massive hedge against the daily volatility of the wholesale market.
Finally, strategy number 3, co-located hybrid structures. This is where you literally pair the battery storage directly on-site with the renewable generation asset itself, like a massive utility-scale solar farm. Now, instead of that solar farm dumping its power into an already oversaturated midday grid and actively paying to offload it during those negative pricing windows we talked about, it charges the co-located battery directly. You internally balance your output behind the meter. By structurally combining generation and storage this way, you completely bypass that wholesale market traffic jam. You avoid negative pricing windows altogether, securely holding onto that clean power and discharging it only when the grid actually needs it. And obviously, more importantly, when it's economically advantageous for your balance sheet.
So, let's wrap this up. The pivot away from pure merchant risk? It isn't just a passing trend. It's a fundamental requirement for survival in a maturing energy market. The traditional buy low, sell high playbook has been completely rewritten by extreme market saturation, which leaves us with a really critical, urgent question drawn straight from the realities of today's grid. Asset managers and financial investors watching this explainer, how are you restructuring your long-term financial models to hedge against negative pricing and collapsing arbitrage spreads? It's the big question, and honestly, it's the one that will define the winners and losers of the next phase of the energy transition. Thanks so much for joining me today.